Many of the Chinese companies that trade in New York can be found here at the NASDAQ in Times Square, known for high-tech startups and businesses of the future. Chinese firms also trade here at the venerable New York Stock Exchange in the financial district of Lower Manhattan. They're known as ADRs, or American Depository Receipts. It's a mechanism allowing American investors to invest in Chinese companies in the blink of an eye without involving banks or complicated and time-consuming foreign currency transfers. But the mood for investing in Chinese companies has cooled in recent years. And there's one huge Chinese company with a tiny name that can be blamed for that. Didi, the Chinese ride-hailing technology company, came to market in New York in July 2021. However, 2 days later, Beijing clamped down on its operations, citing security concerns. Didi's share price collapsed. New York investors were dismayed.
I think it was an eye-opening experience for investors that not everything that you buy that's hyped up was going to have massive returns.
But things may be improving. In August, Beijing and Washington agreed to allow US accountants into China to audit the ADRs for themselves, with the aim of ending the threat of delisting such companies from the New York exchanges because of a lack of transparency. The head of the leading regulator, the SEC, Gary Gensler, called it a major breakthrough. Auditors from some of Wall Street's biggest names are already in Beijing looking at the books of key Chinese companies, and reports suggest things are going well. But much depends on what the auditors are actually allowed to see. Results of the audits may start coming through in early 2023, though Gary Gensler warns if things don't work out well, delisting could be back on the agenda here in New York. The investment bank Goldman Sachs says that the fear factor among US investors of investing in Chinese companies has slipped from 95% in March this year to 50% as a result of the audit agreement.
What a lot of investors will look for is to have these audit teams come back to the US to where they're not in China and then report.
Tim Anderson says the auditors need to explain the similarities and differences between auditing in the US and in China.
Was it 100% identical? Was it 80%? Was it 75%? Was it 50%? Even if it was 50%, it's probably a step in the right direction, more than they've ever gotten in the past. But if it's 50%, a lot of investors will say, I think I need a little bit more than this.
It's been a tough couple of years for US-Chinese relations, most notably the Holding Foreign Companies Accountable Act, the Anti-Chinese Competition Act, the threat of delisting, a growing list of Chinese corporations Americans are banned from investing in, and the far more hostile tone of the Biden administration towards China. But the recent face-to-face between President Xi and President Biden on the sidelines of the G20 in Bali has been noted here on Wall Street. These company audits in Beijing are being watched very closely indeed here to see if there is a thawing of relations now between the two biggest economies in the world. John Terrett, CGTN, on the trading floor of the New York Stock Exchange.